The macroeconomic news flow in the weeks leading up to and coming out of Christmas is going to be quiet, and the corporate news thinner still, so this seems a good time to take stock. In this video, we're going to look at the key themes which shaped financial markets in 2024, and in the next one, we're going to give the old crystal ball a polish and have a stab at working out which themes may influence 2025 and beyond. In some ways, 2024 was a bit unusual because the consensus macroeconomic view played out exactly as expected. Inflation cooled, there was no deep economic downturn or even a downturn of any real kind, and interest rates started to fall. As a result, equities did well, again, led by technology and AI related names, again, with the result that the US stock market outperformed, spearheaded by the Nasdaq, again, while Japan's benchmark indices did better than those of Europe, which in turn generally did better than those of the UK, while emerging markets lagged, even as China put on a bit of a wiggle towards the end of the year. Meanwhile, holders of benchmark 10-year government bonds found they're going pretty tough for the third year in a row, at least in capital terms, and they did so on both sides of the Atlantic, while commodity prices rose, on average, for the fourth time in 5. However, oil did poorly, gold did well, and Bitcoin went wild, again. These trends leave 2021 and 2022 looking like a bit of a post-COVID-19 aberration and suggest the long-term trend of cheap energy, cheap food, cheap goods, cheap labour, and above all, cheap money that began in the early 1980s, well, that trend continues to reassert itself. It's therefore worth thinking about what happened in 2024 and why, and whether these five trends in particular, can be helpful in 2025 or influential in 25 and beyond. The first trend is cooling inflation, which headed back toward the 2% target laid down by major central banks. Now, that said, much of the improvement in inflation came from oil and energy as well as goods, where unblocked supply chains helped supply and the lagged effect of higher interest rates took some of the edge off demand. Service inflation remains sticky, however, and that could yet prompt workers to demand more by way of pay increases, so perhaps central banks cannot be too gung-ho with further interest rate cuts just yet. The second trend is steady economic growth. A global slowdown did not materialize in 2024, despite disappointing growth from China, Japan, Germany, and France, 4 of the world's 7 biggest economies. India took up some of the slack, the UK emerged from 2023's shallow downturn, and America once more led the charge. The Biden administration's CHIPS and Inflation Reduction Acts buoyed output, and American consumers kept spending, helped by rising house and stock prices. America's latest debt ceiling breach gave no one any pause for particular thought, even as the deficit soared, and President-elect Trump's plan to raise revenues through tariffs has provoked as much concern as it has positive comment. If Elon Musk succeeds in cutting US government spending and Trump rolls back the Inflation Reduction Act, there could yet be some unpleasant, unintended consequences. The third trend is cheaper money. A tally of 175 interest rate cuts worldwide in 2024, compared to just 28 rate hikes, well, that tells a story of its own. The UK, Japan, China all added fiscal stimulus to fresh monetary stimulus, and you could argue the USA did as well, given how the federal deficit grew by another $1.8 trillion to an all-time high of $36 trillion. The question for 2025, then, is whether a combination of sticky inflation, steady growth, and ballooning government debts, and thus rising sovereign bond yields, crimps central banks' room for manoeuvre and forces the pace of rate cuts to slow, or in a worst case, come to a halt. The fourth trend is the surge in perceived haven assets, a bit of an outlier given how bullish everybody seems to be. Silver hit a 12-year high and gold, and most spectacularly Bitcoin, set new all-time highs. Such demand for havens doesn't really sit comfortably beside equity's core scenario of cooling inflation, steady growth, and lower rates. It may be the result of fears that central banks are playing fast and loose with inflation, or that ever-growing sovereign debts are persuading the central banks to cut rates and ease government interest bills, whether they feel it's appropriate or not. President-elect Trump's enthusiasm for all things crypto, his planned deregulation drive, and the departure of Gary Gensler from Securities and Exchange Commission all mean Bitcoin's up 40% in barely 2 months, helped by what can be seen as increasingly reflexive exchange-traded fund flows. The higher Bitcoin goes, the more buyers appear, and so on, in a clear win for momentum over value investors. The fifth and final trend is another slightly discordant note, as sovereign bond yields tick higher and prices go lower. This matters because the 10-year bond represents the local risk-free rate and thus the benchmark minimum return for any investment that's acceptable. Yields on 10-year paper rose and prices fell despite interest rate cuts, to suggest that bond vigilantes are becoming nervous about governments' debt piles in the US, UK, and EU, and whether there is the political or public appetite for the tax increases and spending cuts to fix them, at least in the absence of growth or inflation reducing ever growing debt to GDP and interest bill to total spending ratios. Anyone who bought 10-year bonds in 2020, when central banks were indiscriminate buyers thanks to COVID fighting quantitative easing schemes, has subsequently suffered, to perhaps offer a reminder that valuation does always matter in the end. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you next time when we shall look at the key macroeconomic trends that may be important in 2025 and how they could in turn shape portfolio performance.